Roger, I recall you made a statement at the beginning of the year that was something like prepare for your super fund to take a bath this year when actually they've enjoyed good returns. Care to clarify? Um, yes, happy to clarify. I was wrong. Um, I don't know where the stock market is going to go. Never will know where it's going to go. So if I write a headline like that, you should pay no attention to the headline, but nevertheless, you should pay attention to the arguments. The stock market can remain expensive for a very long time. Prior to the GFC, Warren Buffett had something like, and I'm stretching here my memory, but he had something like 50 or 60 billion dollars of cash in Berkshire Hathaway to take advantage of an imminent collapse. Now, what's interesting is he was building up that cash for 2 or 3 years prior to the correction. So, like Buffett, I don't know when a correction is going to actually occur, but I am observing an increasing number of signs that the market is getting expensive, as we just saw with Skaffold. If you look at the large cap companies, there are no high quality companies that are cheap that meet all those other criteria that we looked for. So that tells me we need to be cautious. It's not saying the market's going to crash. It could be that the prices continue to go up, just as they did after Buffett started amassing cash in Berkshire Hathaway for several years. And in fact, I'm cautiously optimistic. I do believe we could see higher prices. In essence, what I'm doing, and I'll switch back to the presentation here for a second. In essence, what I'm saying is this: the market is expensive now, and it was expensive earlier. So your observation, Chris, that super funds have enjoyed good returns. How have you measured those returns? You've measured those returns because prices have gone up, and I'm not suggesting they can't keep going up. They may keep going up, but as they do, you need to be increasingly cautious. So if prices continue to go up from here, over at Montgomery, what we're doing, our models cause us to sell shares and not reinvest the money. So it causes us to raise cash as the market gets more expensive. If a correction does transpire and all those doom and gloomers are right, and I'm not suggesting that they will be, but let's suppose that they are right, and the market does correct at some point, well, I am glad that I've got Skaffold to tell me which are the high quality businesses that I should buy. Over the last 3 months, since July 1 this year, we conducted a study on which quality scores did best. And here's the interesting thing. Since July 1, A1 companies have been the single worst performing group if you look at their share price performance. Prior to that, they were the best. But since July 1, so this last 6 months, they've been the worst. Now, Credit Suisse released some research last week, or I think it was the week before actually, late the week before last week. They released some research looking at different investment styles. So one of the styles was growth, one of the styles was value, another style was momentum, another style was yield, another style was quality. And they observed that in the summer of 2013, in the US summer of 2013, the single worst performing style was quality. They went on to suggest that you may, as an investor, want to switch out of quality and go into lower quality companies with momentum, because as the economy starts to pick up momentum, investors throw caution to the wind and start to buy stocks that are cyclical in nature, that are lower quality, and those are the ones whose share prices will go up. Now, Chris, your question about saying that super funds have had a good return this year based on the price, absolutely correct. If you look at the advice that's being touted by some brokers, they're suggesting a move out of high quality into lower quality and into cyclicals because the economy is recovering in the United States, and you're going to benefit from share price increases there. All of that could be true, but it's not the game that I play. It's not the investment strategy I adopt, because I might think that now is a good time to get out of high quality and into lower quality, but gosh, I don't know when to get out of lower quality. When will I get out after the share prices have gone up? What I do know is that over the long run, if you stick to quality, you make sure you don't bet the farm on any one particular company, and you buy businesses at a discount to value, and you buy businesses with great prospects. If you do those things consistently on a portfolio basis over long periods of time, I have an absolute belief that over the very long run, you should be able to beat an index that is based only on size and on sector and not on quality. So if you stick to those things, I think you'll do very, very well.